Good day, trader. My name is Wasku Smart FX. Okay, welcome to our YouTube channel. Today we'll be talking about how I'm able to make out this 1,000 pips plus on gold. That's 1,320 plus pips on gold. And we're looking at why I took the trade, what is the strategy behind the trade, and what is the pattern, what are the things that comes together to bring out the trade. Okay, for this particular trade here, what comes together to bring out this trade is what I know as the top-down analysis plus the entry pattern. If you have been following me for a while, you will know I always talk about top-down analysis, and there are some components I talk in top-down analysis. There are three components in top-down analysis. The first one is the draw on liquidity. Where is market going to? The second one is narrative. How can we get to where market is going to? What can we use? What point of interest can we use to get to where market is going to? And the third one is what they call candle signs. That is, when should we participate in going to where market is going to. So today I'll make use of two, which is draw liquidity and narrative. So draw liquidity is where is market going to. The narrative is where can market use to get there. So the strategy I use is draw liquidity, the top down analysis plus entry pattern. So when I found my where market should use to get to draw liquidity, then I make use of my entry pattern. And I have three entry pattern, but for this particular video here, I'll be only dropping one because that is what I use on this particular trade. People that have been following me for a while, they will know that I talks about intermediate time high, intermediate time lows. So I'm not using that here, but what I use on this particular trade is what I call order block. And this is where I found my order block. When market took out the liquidity here, the market, so this is the component of this order block. Market took out the liquidity. Market did not break this low. The market enter a fair value gap here, so which means the market closed an imbalance. Then this particular block that took out the liquidity here is what I called another block. That is my idea on another block. And okay, so let's go into the chart and see. So this, let's first look for the draw on liquidity. Where is market going to? So for this particular trade here, you can see market was being bullish on daily chart, and at this particular level here, market enters into a fair value gap, then market buy. But market took out the liquidity here just a little bit here. Well, I don't count it as liquidity taking, but market took out the liquidity just like market get to that exactly. You can see just a little bit market took out the liquidity, but I don't count it as market taking out the liquidity. So I expect markets to come back there anytime and more. Okay, so market to enter into the other fair value gap. You can see that every retracement market is doing, market is entering into a fair value gap, then continue buys, then enter a fair value gap, continue buy. But at this particular point, let market enter into the fair value gap, then market comes back here and break the structure. Okay, I have these things here on 4 hours chart. So for me, so on 4 hours chart, you can see this is the particular zone the market enter into the fair value gap. Market comes back to this high here, so just a little bit. But this is the zone market enter into the fair value gap. The moment market breaks this zone on 4 hours chart, will signifies that market has changed the structures. The moment market breaks any lows that has traded into a fair value gap on higher time frames, it means that market changed the structures, except if there is an higher time frame fair value gap below. That is the only reasons. And here you can see on gold, this is not what you are looking out to, but you can see on gold that there is a fair value gap on weekly chart. So weekly is more higher than daily chart, so which means that is what market actually go for. But on this particular level here, the moment market creates a fair value gap on 4 hours chart, this turns to our narrative. Now the question is, where is market going to? That should be the question. Where is market going to if this is our narrative? Because market has changed the structure. Then we go back to a weekly chart. You can see that this low, there is a fair value gap here, and that is our narrative. That is our draw on liquidity. where we want to see market to come to, and you can see that this at this particular level, that is our draw on liquidity. So if I go down to 4 hour chart, you're going to see it here. So this particular level is our draw on liquidity. So we expect market to come back into the weekly fair value gap. So that is why I said, okay, so now when market retraces to this fair value gap, I already have a draw on liquidity. I have a narrative, which is this, that is where I'm looking for the sell. So then I go down to lower time frame to look for my entry pattern inside the narrative. And if you check it here, you can see the market is being bullish here. Every high is being broken, market will trade back to the fair value gap. Then at this particular level here, you can see that market has been bullish. Okay, at this particular level here, you can see that when market is retracing to the 4 hours fair value gap, which is the narrative, market is retracing there with a bullish distribution. So there's a distribution whereby market break the structure, enter a fair value gap, break structure, enter a fair value gap, break the structure, enter a fair value gap. Then when market get to this level here, market was close the imbalance, the fair value gap. Market close the fair value gap before market breaks the low, before market breaks any of the major lows, and don't forget, my entry pattern is that when market creates something like this, which means the market is bullish, then at this particular level, after taking out the liquidity, market did not break this low. For change of structures, it first close the fair value gap, then break this low. This particular level here, it shows to us that there is there's an endorsement on this high, and there is a block which used as order blocks. So that is the order blocks. That's my definition of order block. But there's something here, okay? There's something at this particular level here which we call the proportion block. Proportion blocks is the block or is the candle that enters or that trade into another block. And this is the block here. This particular candle here is a proportion block because it traded into another block. So for not missing the trade, we can actually use the proportion block as an entry and put our stop loss above that other block, or we should make use of the other block itself. So making use of the other blocks, you can see that the proportion block traded into the other block, and most times market don't usually trade to the other block. They just use the proportion block and go. So that is how we got our entry. And on this, the way I gave out my trade, you see that I use this low as take profit. So this is the low I use, even though I know that this is where market is going to, but this is where I use. So putting out my trades on the proportion block, because that is what I use actually. I don't want to miss out on this particular trade. My stop loss above it. So take profit, that's 1 to 6, 1 to 6.2. You can see that the moment market gets to the proportion block, you can see what market did. Market reject, but that is still not it. Market later enter into the other block, then market trades all the way down. So that is the idea of the trade, and that is what we took on that trade. Thank you so much.